All right, everyone, we are at 12 o'clock, so I will go ahead and start today's program. Welcome, and thank you so much for attending. My name is Alison Helland. I'm the Director of Donor and Advisor Engagement at Madison Community Foundation. I've been at MCF for about 2.5 years, where I work with donors, fund holders, and advisors on reaching people's charitable giving goals. Prior to that, I was an attorney in private practice, so I always love these opportunities to engage with my fellow attorneys and advisors out there who are working with clients. I also wanted to make sure to thank you for the work that you do on a consistent basis to advance the conversation around philanthropy, both with your clients and your colleagues, but in the larger community. We're really honored to work with you in advancing this conversation and to help your clients meet their charitable goals. As I mentioned, this webinar is the second in 4 webinars that we'll be hosting this year. So I will be sending out information about an August and October webinar at a later time. We have great speakers here today and a very timely topic. Before we jump in there, I just did want to give you 3 reminders. The first is, if you are an attorney practicing in Wisconsin, the Board of Bar Examiners has approved this program for 1 CLE credit if you are watching it live now. If you're watching it on a replay, my understanding is you do not qualify for credit. Second reminder, please save the date. We will be hosting our in-person advisor event on September 10th from 2:30 to 5 p.m. at Monona Terrace. Our featured speaker will be Brian Klontz, who will be talking about planning for gifts of non-cash assets. Very hot topic, very timely topic. Anyone working with closely held businesses, you'll want to make sure you're there. We will send invitations for that out this summer, but I did want to just give you the date so you had it on your calendar. And the last reminder I have is, if you do have ideas for a future webinar topic, if there are things or resources that you think would be helpful for us to provide for you to work with your clients, please let me know. Feel free to contact me via email, phone. Caitlin, our Zoom wizard here, will be dropping a link to our survey into the chat function. You will also receive a link via email after the program. So again, we're really doing these in hopes of continuing the conversation and providing resources to advisors that are helpful. So if there's anything that you think we can be doing better or addressing more, please let us know. With all of that said, we will jump into today's program. I'm very excited to be joined by 2 amazing advisors here. Jennifer Ridley Hanson, she is Director of Wealth Planning, a Senior Wealth Advisor and a partner at Slate Stone Wealth. And Jessica Schwantes, she's a CPA and a shareholder at Raucous CPAs. So thank you both for joining today. I'm going to give a little bit of an overview on what we'll be discussing. So we'll start out, I'm going to give a little bit of background on some different giving trends. Then we'll talk about the tax planning aspects of giving prior to and after the Tax Cuts and Jobs Act. Then we'll talk about some giving opportunities under the Secure Act. And we'll spend most of our time talking about having those conversations with clients and figuring out what charitable giving tools and resources may be the best fit for them based on their financial information, their goals, and kind of their giving plan overall. So just to jump in, one of the questions that I get a lot from fund holders, donors, and a lot of advisors is, what is everybody else doing? So I wanted to provide a few slides showing you just big picture, kind of some of the trends that we see in giving. This chart here shows giving from 1982 to 2022. You can see generally it's trended upward. Those lighter blue bars are inflation adjusted. But the overall trend is encouraging as we see more people are giving. The balance in who is giving is changing a bit. We're seeing more giving from more affluent people and slightly less giving from the less affluent people. So I would say the overall giving continues to increase, but the mix of who is giving and how they're giving does continue to change. The other question I get is, what determines how much someone gives? I think the first thing obviously is charitable intent. All of our clients have different ideas of values, what they feel is appropriate to leave to family versus philanthropy, all sorts of things like that. But beyond that, I think there's 2 other things that I hear a lot. And the first is capacity to give, and the second is the ability to give in an effective and tax efficient way. And so I did want to provide some information on kind of the big picture of what that looks like. So this chart, it is based on 2018 data, but I think it does a really nice job of just reiterating kind of how the mix of assets for an individual will change as their net worth increases. And obviously this is important as we look at what types of gifts individuals may want to make and where those will come from. You can see going from this chart, we go from primary residence, liquid assets, cash, things like that, to closely held business interests, real estate, managed assets, things like that. So I think it's just a helpful illustration of the pool of assets that you might be looking at to gift based on net worth. The last slide I wanted to share was just an overview of what nonprofits are seeing. So there's an organization called CCS Fundraising that does consulting in the nonprofit sphere. And they surveyed over 600 nonprofits in a variety of different industries and sizes and things like that to find out really what types of gifts they're getting. So this chart shows what percentage of nonprofit respondents received gifts of certain types. And there are certain things on here that are definitely not surprising: donor advised funds, family foundations, bequests, appreciated assets. But we are seeing that a significant percentage of nonprofits are also seeing gifts from retirement plans, charitable trusts, charitable gifts annuities, and giving groups. So I think, as you're working with clients and as clients are asking, what are people doing and how are people giving, this might be some helpful information to draw on as you're having those conversations. So with all of that said, I'm now going to turn things over to Jessica, who will give us all of the information on the tax world we lived in and we currently live in and we may live in post-2025. Oh, you're muted, Jessica.
I knew that was going to happen. But thanks, Allison, for that. And yes, I mean, not that we want to have a lot about this being in tax updates, but tax impacts and rules impact what clients will go ahead and give and not give. And we are in a period of change coming from that at the end of 25 with the Tax Cut and Jobs Act. So do a little bit of history lessons on that. The Tax Cut and Jobs Act was signed December 22nd of 2017. So 6.5 years ago. And a lot has changed in 6.5 years. I mean, many of us, some of us on this call may not even been, in practice working with clients from that. And others that have been around, a lot has happened in 6.5 years. And we just need a refresher on what those rules are. And so for the slides here from that part of it, we're going to have the rules listed of what they were before, what they were after. I'm going to do a comparison from that part of it just because it's easier in the conversation, because we don't want this to be just a tax update. We really want to get this to how can we help plan for our clients to give. So it's just a little bit more effective to do that way. So Tax Cut and Jobs Act went ahead and reduced the top individual rate from 39.6% to 37%. So some people are like, it's 2.6%. Like that's not a lot of changes from that, but it's significant because it's for those that are making over $500,000. So those are real dollars. Those are bigger checks that get written to the government, and maybe our clients want to go ahead and use that for a different aspect from that. So that was a big change from that part of it. The standard deduction doubled from what it was before. So when we're looking at it here, it's going to get cut in half. And when that rules were changed, so if you take a family of 4, 2 wage earners from that, the standard deduction that went up plus the loss of the personal exemptions, they kind of ended up close to being in the same point. There's the aspect and the idea for the Tax Cut and Jobs Act and increasing the standard deduction was that you can file your tax return on a postcard. We're going to have tax simplifications. And all of us that know that, like, there was nothing further from the truth than that, but that's, that was the campaign promises that were made with that. And with that standard deduction, the most individuals do that for the last 6 years. From that, you just saw the standard deduction taken, not a lot of the itemized deductions. And part of that was the itemized deductions were limited. So the biggest one of the change for the tax law for the itemized deductions that got a lot of talk about it, still gets a lot of talk about it, is the limitation of the state and local income tax deduction capped at $10,000. So before, your clients had their property here in the area, they had a second home, they had a third home, maybe they had a fourth home, they could deduct all those real estate taxes. You had individuals that lived together that weren't married. They each got their $10,000 today. From that part, they get married, they only get one $10,000, so it's $10,000 per tax return. And before, deduct them all from that. So it's a big change. There's lots of states that have gone through and changed their laws for the entities to go ahead and be able to have this part of it, because it was such a significant loss in tax deductions for that. So that's coming back. So yay for all of those of us that live in Wisconsin, we can go back to having full deductions for our real estate taxes and state income taxes. The other piece with that is the mortgage interest. Before the principal balances from that part of it with your mortgage, it was $1 million for mortgage interest that can be deducted. You decided, you know what, I actually like my home from that. I want to go ahead and remodel my kitchen because that's the part I don't like. And you could take out a home equity loan, remodel your kitchen. You could go ahead and deduct that mortgage interest there. When the Tax Cut and Jobs Act was signed, nope, sorry, you lost the home mortgage interest for the remodeling for the home equity loan, and your loan had to be under $750,000. Now, 6 years ago, $750,000, that was like, okay, fine from that part, especially for our area of the country. But now from that's a lot, more significant from that part of it. I have done more mortgage interest limitation calculations in the last 3 years than I did in the first 20 years of my career. I could count on one hand how many did, and all of those properties were for those that relocated to California. But it's way more significant, that piece of it. And for many of us on our call had from that, this is called miscellaneous itemized deductions. And like, I can deduct my tax investment or my tax prep fees. They can deduct my fees. They can deduct their investment advisor fees. Have a home office here. My employer from that part of it doesn't reimburse for the home office. I can go ahead and deduct all those. Once the Tax Cut and Jobs Act was signed, those went away. They weren't possible, and made some really kind of awkward conversations with clients like, hey, your tax rate is going up. And they're like, why? Well, you can't deduct my fees anymore. So now we can be like, hey, you can deduct my fees from that part of it. So to do that, but that one impacted retired individuals the most. I mean, and so many of our clients that work with us, they're in that stage of their lives. And so that had some impact on them. Like I said, highlight before, this personal exemption. So before it existed, so every individual was $2,000. It's indexed for inflation, but you got it, your spouse got it, your kids got it. Now there was phase out limitations based off of your income for that. But you go ahead and have that. And so that's where, when you start a new job and you fill out your W-4 form, maybe like single, married, you claim 0, 1, 2, what's your number? It all kind of related to what's your personal exemptions, how many do you have, and how much kind of really are you doing itemized deductions for that. So it was, a different conversation from that part of it. In a divorce situation, who's going to claim the kids, other than the child tax credit, it really didn't matter. Now those conversations are going to come up and matter again. So the other piece on that part of that's coming into changes relates to, Alison, want to flip one more slide? It is the AMT tax. And so for now, that changed from that part of it, where the exemptions and for AMTs was $500,000 or $1 million for a married filing joint. So you just don't see AMT tax calculations. Before, it was pretty much seen a lot from that, roughly for maybe 2 wage earners, about $400,000, if I can go back into the memory vaults about that long ago to do that. But it'd be about $400,000. And so it was a lot harder to do a back of the envelope calculation for tax for clients, because you had to do the regular tax calculation, and then you had to go back and go ahead and do the AMT tax calculation, do all the different phase outs to kind of really figure out what their effective tax rate was. You couldn't say, you're in this marginal tax bracket, and you go ahead and do an extra $10,000 in charitable giving deduction. You're going to go ahead and save 32%. And go for it. Like, you don't have that ability to kind of just spout that off, because the AMT is going to come into play. So a little bit more tax planning that's going to have to be done and more thoughtful on that. And the other one, this QBI deduction, qualified business income. So many provisions in the Tax Cut and Jobs Act sunset and expire here, which is why we're talking about this at the end of 25. The one that does not is the corporate rate. And so corporate rates before, were corporate being C corporations, were 34%. They went down to 21% with the Tax Cut and Jobs Act, and that stays. But many of our clients and many that we work with, our business owners, are a partnership or an S corp. So all that tax is paid on their individual tax return. And they're like, well, that's not fair. My C Corp counterparts, they get a huge tax savings and I don't. 2% is not enough to go ahead and equate for the savings that they're getting. So this QBI deduction was created, this 20% deduction, but that's sunsetting. And so for our clients to say they're going to lose a 20% deduction from their business income, that's huge. That's going to go ahead and impact them. And so they're going to be looking to us to say, okay, hey, I need some tax planning opportunities. What's available out there? So hence charitable contributions is something we're going to go through as an opportunity for them. And the last one that I want to highlight on here from that is the estate and gift tax. And so the estate and gift tax was roughly $5.5 million at 2017 per person, basically doubled on that part of that when it was signed. And right now we're just under 14 million. That's going to go back to what it was at 2017 plus inflation. So, you got to guess inflation rates between now and 2026. So just say somewhere between 6 and 7 million. But that's a huge opportunity in estate planning. So for, some of them you can say, hey, I can save you $2 million just from doing some proper estate planning. I mean, we're going to look like heroes to say that we're going to go ahead and be able to save clients up to $2 million. So estate planning conversations, deductions, that's not the intent of this one, but I just want to go ahead, since I have a captive audience, like that is an opportunity that we need to consider with our clients to really be beneficial to help them with the type of wealth preservation that they want to have. So like I said, all this we went through to set the stage because they're sunsetting and expiring at the end of 25. So we have 18 months basically to go ahead and help our clients plan for this. So now I'll go ahead and let Jen kind of work on go over some items that we can help our clients through that.
Great. Thank you, Jessica. So I think I'm off mute. So good. So I do want to talk about, how you can be a hero for your clients. I think that's really our role as an advisor. So we're definitely going to talk about some of the strategies you can use, some of the things that you may be familiar with or maybe not. But we did want to kind of go back and again, talking about what the past used to be and what might be coming back. There's a couple other new laws that came into effect in the recent years that I want to just go through kind of briefly here. So the first one was back in January of 2020. So if you remember January 2020, seems like a really long time ago. That was actually before COVID really was a thing. Okay, so like seems like a really long time ago. So there was a major law change called Secure 1.0, and that was the law that changed the RMD age from 70 and a half to 72. So I think when I started this business in the 1990s, it was always 70 and a half. And it was such an odd age because why is it a half? But it was a half. And so now that became 72, and a lot of people still had the 70 and a half kind of stuck in their head because it's a fairly recent change that had been 70 for so long. And now what we'll talk about coming up is now that age has been extended even further. But the 72 was the change that came about in 2020. The other thing that we got, which anyone who's an advisor today has to love, that the inherited IRA rules and how much these have changed. It's really hard to keep track of. It's hard to keep clients straight on what the new rule is. But basically everything that previously had been established for inherited IRAs, where clients basically receiving an IRA from a parent could typically stretch out those RMD payments over their life expectancy. So that all changed with this law in 2020. So no longer do we have life expectancy. Now we have a 10-year distribution period for non-spouse beneficiaries. And that's something that still, this exists today. There's a lot of confusion around it. The IRS has really given people, I think, leniency on when they're required to draw because the law was so unclear when it first came out. And we'll talk a little bit more about that as we kind of go on today. But that was where the 10-year rule came from, was the Secure Act 1.0. And like I said, it's really challenging to work with. And so Secure 2.0 then came about in 2022. And so really the whole point of this one was kind of an update to Secure 1.0. And here's where we got the RMD age now extended. So no longer 72, it became 73, starting for those turning 73 in 2023. And now that age is going to be extending out to 75 in 2033. So those people turning 75 in 2033 will start taking their first required annual distribution from their IRA accounts. And so that age, may change over the years. Maybe it'll be sooner than 2033 that it goes from 73 to 75, because that's a 10-year time period, whereas it went from 70.5 to 73 in a short amount of time. So we'll see how that changes. The other thing that came about with Secure 2.0 was this qualified charitable deduction. So again, many of you may be familiar with that. We'll talk a lot more about that as we proceed today. But that Secure 2.0 gave an inflation adjustment to that qualified charitable deduction, which had been 100,000. So it had been 100,000 for many years, and now we're getting inflation adjustments. So currently this year, an individual can give 105,000 out of their IRA directly to charity. So the whole point of the QCD is using IRA money that would have been a taxable required minimum distribution RMD and turning around and giving it directly to charity. Therefore, you're avoiding the income tax on that distribution. So for our clients that have large IRAs and large RMDs, this is a huge advantage for them. So if you're not talking to clients about this or not familiar with it, this is probably one of the most utilized strategy I think I see in my practice today. The other thing we got in 2.0 is the ability to fund what's called a charitable gift annuity, CGA, or a charitable remainder trust using QCDs. So previously, you really had to be using non-IRA assets or things like, low basis stock or cash or different property to fund a CGA or a CRT. And so we'll talk a little bit about what this means for clients who maybe don't have assets to put into a CGA or a CRT that they could possibly use some of their RMD to actually make those gifts through a QCD. So we'll talk a little bit more about that as well. So a little bit more on the QCD. So as I said, it's somebody taking money from their IRA that would have been an RMD and giving it directly to charity and reducing or eliminating the income tax on that amount. One thing that I think is interesting to note about this is even if you have to be age 70 and a half to do the QCD, even if the RMD age for you is 73 or could be 75. So some people kind of get confused on that. So you have to really look at your client to determine, is there an advantage to take money from the IRA prior to the RMD required age? So take it at 70 and a half or 71, rather than take it from a different source if they have charitable giving. So I think what we'll talk about as we kind of get further into this program today is how to you as the advisor know what's the best bucket of money to use to make a charitable gift. And a lot of it is just knowing what's available out of which account and what does your client have and how do you best really utilize it. So, in some cases, the client wants to reduce the value of their IRA today at 70 and a half because they know those RMDs are going to get bigger and bigger down the road. So that might be a reason to take a QCD out of the IRA before you're technically required to draw an RMD. So there may be reasons. And again, that's kind of a case by case knowing your client. But I would say the QCDs are very, very popular. A lot of our clients do that. Our clients have an IRA checkbook from their custodian. So it's really convenient if they're, going to church and they want to make a donation, or they're going to an event and they want to be able to write a check out of their IRA. It makes it really, really easy to kind of put that in their hands. So that's something that I think has come about that a lot of people just love the convenience of. So that's something I would say, if you don't have that, maybe look into how to get that. The last point I want to make on the QCD is so this first came about in 2006. And in 2006, it was kind of a year by year decision as to whether or not a QCD was allowed. And so for some clients, we had to wait literally till December to know if we could make this charitable distribution out of the IRA. And then it became permanent in 2016. And so for some clients who did estate planning or maybe set up some type of foundation prior to 2016, their plan may need to be updated, or there may be other options to look at based on what they can do now versus what they could do back then. And so those are the kinds of things that I will talk a little bit more about. And so the last point I want to make on this before we do move on, I guess 2 more points. One is, this is also really confusing. So the client can do the 105,000 QCD, whether their RMD is, so that's the max they can do, but that doesn't have to be their RMD amount. So let's say their RMD is $50,000 they're required to draw. They can do the QCD for 105,000. Okay, so they can take out more than they're required. And that, again, you've got to decide, is that the best place to take extra money out, not pay the tax, but you're not required to pay the tax? So is it still really valuable to the client to do it that way? So that, I think, is something that there's been a lot of confusion about that dollar amount, what it means related to the RMD. The other thing, just before we move on with this, is keep in mind that because the qualified charitable distribution is not taxable for income tax purposes, the client's not going to get a charitable deduction for that. Okay, so I think that's the other thing too, that there's a lot of confusion on, because you're so used to, kind of like Jessica talked about, clients get this charitable deduction when they can itemize and there's benefits doing that, but the QCD doesn't go on that tax schedule. So that's something else to kind of keep in mind, that if the client can itemize, you again might be looking at different options for giving, because there might be more benefit to them to itemize versus what they might do with the qualified charitable out of the IRA. So a lot to think about there. So we can move on. Okay, so next thing on the qualified, as I said before, you've got to be 70 and a half. A lot of people miss that and think you've got to wait till 73. It has to come right from an IRA, not from a qualified plan. Technically, you could use an inherited IRA or an inherited Roth IRA for a QCD, but you still have to be 70 and a half. And so I think it's kind of hard to think of someone who gets an inherited IRA, typically it's from like a parent. And so for you to be over 70 and a half when you get that IRA, there's not a lot of situations where the client is at that age when they receive the inherited IRA. They're usually much younger and usually required to draw it out over 10 years, in which case it's long gone by the time they get to age 70 and a half, if that makes any sense. And I think when you look at the inherited Roth, there's really no tax advantage to take money from an inherited Roth and use it as a qualified charitable distribution. But I think there again, as the advisor, you need to kind of look at what all does a client have to give from. And in some situations, there may be a case where that's the only or that's the best choice to make that contribution out of. But again, that's something that you need to kind of weigh all the different options for that kind of a situation. So the last part of this is, again, just making sure that the distributions are going to a qualified 501c3 charity. So that's also really important. Money can't go to any other place from the IRA. It's got to be qualified, and the custodian will actually send that money out. If the client writes their own check, it still goes through the custodian to kind of make sure it's going to the right entity. And then it just has to go directly. So the client can't take the RMD in their own account and turn around and pay it to charity. It's got to come directly from the account itself. And so that's something that even when the client does their own checkbook, it's coming right directly from the account. So that wouldn't make it disqualifying anyway. So next, I think we want to go to the next slide, Allison. So I want to talk a little bit about the the charitable gift annuity. So this, I mentioned just briefly, this basically gives people the ability to make a tax deductible gift, but they also get income. And so I'm going to have Allison talk a little bit about kind of how this works, because the Madison Community Foundation can provide some of the administration for these types of accounts. The one thing that's different with the charitable gift annuity is if you think about the client making the gift to charity out of their IRA, so as a qualified charitable distribution, the client doesn't get anything back from that, right? They give $100,000 or $105,000 to charity. That's the end of it. They don't get any money in return. They get the feeling good of making a gift to charity, and that's important for their goals, but they're not getting anything in return. And so I think when you look at like the charitable remainder trust and the charitable gift annuity, the client's making a gift, but they're also getting something in return. And that's kind of part of, for some clients, that's part of the appeal, is that I don't want to just give it all away and not get anything in return. And so that's where this charitable gift annuity can come in. And now clients can use a QCD to fund that. And that's something that was new under the Secure 2.0. So it had not been that way in the past. Normally a client would have to use non-qualified assets, stock, cash, other property to put into the CGA or the CRT. So Allison, do you want to talk a little bit more about how that might work with the Community Foundation and what this opportunity is? You probably see more of this than I think I do in my practice.
Yeah, happy to do that. So as Jennifer said, this is a great opportunity if you have a client that is very interested in gifting, but is just not ready to part with the entire kind of lifetime benefit of an asset, right? So basically what happens is a donor or donor and their advisor would come to me or one of my colleagues at MCF and say, we would like to set up a charitable gift annuity. What I would do then is I would get some basic information from them, basically if it would be a single life or for two lives, the ages of both annuitants, and then the amount that they would want to put into that. What we would do at that point is we have software based on the IRS valuation and calculation requirements that would figure out what the present value of the donor's gift would be. That's based on life expectancy, other actuarial things. And basically what would happen is the donor would receive an immediate tax deduction for the estimated value of that gift based on the calculation. But during their lifetime, they would receive a stream of either quarterly or annual annuity payments. And so what the software essentially does is it splits up what part of that amount they're giving is the remainder that will be the actual gift and what part will come back as the annuity. And so the tax treatment of those payments, those annuity payments, can be mixed. So there will be some portion that you might have to treat as capital gains versus return principal, things like that. And we provide a sheet that kind of breaks out how those payments are treated. So from the donor perspective, it's really a matter of letting us know some basic information, the amount of the gift, and then entering into a fund agreement with us for the charitable gift annuity. And then we take care of the administration and obviously getting the payments out and then providing the 1099 information necessary in order to classify those payments. So we try to make the process very easy. It's a great tool for people that are kind of getting into giving and are very interested in legacy giving, but are not ready yet to take the jump of maybe completely, giving assets without receiving any sort of income stream in return. Secure 2.0, as Jennifer mentioned, is giving people the opportunity to fund a CGA using QCDs. They are limiting the amount that you can put into the CGA. So it's 50,000 indexed for inflation, which means $50,000 this year. They also require that the annual income payments begin within 1 year. If you're doing a traditional CGA, not using QCDs, it is possible to have that CGA set up to start at a later time. If you're pursuing this option under the Secure 2.0 Act, you don't have that option. It has to begin within 1 year. The other thing that I think is really important about this QCD funded CGA opportunity under the Secure Act is the tax treatment is very different than if you would fund the CGA with non-QCD assets, essentially, right? Obviously, the government wants to get the one bite at the apple, and QCDs are, from traditional Roths typically have not yet been taxed. So in looking at that, they're saying, well, wait a minute, we're going to make sure that we get tax treatment on this, especially because we're giving annuity payments back to people during their lifetime. So you don't get the tax deduction when you create the CGA if you use QCDs to do it. If you use QCDs to create a CGA, you will also have those annuity payments you received taxed at ordinary income tax rates, which, as Jessica can, I'm sure, confirm, is not the best thing you like to tell a client about the rate of tax they're paying. It's not the best one. The third thing is there are limitations on who the payments can go to. So they can only go to the person setting it up or their spouse. In a typical CGA situation, sometimes you can set up a payment for a child as a second life or something like that. If you're using QCDs, it can only be the person making the annuity or their spouse. So I think Jennifer kind of alluded to this before. This might be a nice tool for a client that has not a lot of other options as far as getting, their charitable giving started. But, it's not something that I think many people would look at as being very favorable given the tax treatment that's required if you are going to use those QCDs to set up a CGA or a charitable remainder trust.
All right, so I'm going to talk about donor advised funds now. So when Alison showed one of the charts at the very beginning of the program today and looked at what clients use, what vehicles are used for giving, the donor advised fund was the tallest of the bars on that chart. Donor advised funds and the family foundations, which we're going to talk about too here just in a couple of minutes. So what is a donor advised fund? Again, these have become very, very popular over the last couple of years. I use this strategy a lot with my clients. So basically, when you set up a donor advised fund, the client gets the charitable deduction in the year that the gift is made to the donor advised fund. So I think that's, again, where you as the advisor, you've got to kind of look at and working with the tax advisor on the team as well, what makes the most sense for this client? Do they get a better advantage by doing a large gift that's going to give them an itemized deduction, charitable deduction, or do they really need to avoid the income tax on their RMD and therefore a QCD is better? You can have both. I mean, there's no reason you couldn't have both. I think it depends on, again, the resources of the client and really what their main priorities are. And I think you as the advisor knowing this is kind of the biggest pain point for the client, or here's where they end up paying the most in taxes, or here's what I see as being the biggest challenge for this family down the road in terms of the assets that they have and what they want to pass to their family. I think certainly as we talk about things like the estate tax limits going lower, very, very likely in 2026, there may be clients that have the estates that are already large enough that we want to kind of look at how to shift things around. So anything that would go into a donor advised fund, that's not included in the client's estate for estate tax purposes. So that's something I think really important to know that's kind of out of their number. And so the donor advised fund, again, lets clients set aside money for charitable purposes. It can go to multiple charities. They put the money in at the beginning, and then at the current law, which Alice is going to talk about some proposed changes here. Current law is you put the money in, you get the deduction up front. You don't have to make an annual distribution out of the DAF to charity. You can let it sit in there and grow, and you can distribute the funds down the road. So it's very flexible as opposed to the QCD. You're writing that check, and that check is going to the charity today, and that's money that they're spending today. There's nothing ongoing from that. So I think that, again, is some clients want to give money today and down the road, or have the ability to kind of dole that out over time, and again, to multiple charities. So that makes it really flexible. So in terms of funding the donor advised fund, most clients are using either low basis stock. So let's say they own a big position in stock and we don't want to sell it because of capital gains, that can go into the donor advised fund. Some clients have used excess cash just because they have it. Some clients have used things like a business interest or real estate. So there's a lot of options there for how to actually get money into the donor advised fund. And then there are different versions, which I'm going to have Alison talk about some of the sort of the flavors of the DAF, the endowed, the non-endowed, and kind of in between. Some of these are funds that Madison Community Foundation can actually set up for your client. And so I think one thing we'll talk about is how complex does your client want things to get, or how complex do you want things to get for you as the advisor with the client? What are the easy things to do that are kind of low cost, low administration? And then what are the things that really complicate everybody's lives, but there's a reason for doing it that way? So Alison, do you want to maybe kind of talk about on the next slide what the differences are with those different DAFs?
Sure. So one of the questions I get from people are, why are there different kinds of DAFs? What do all the different DAFs mean? What do they involve? What's the nomenclature around it? And so I just wanted to give a few basic terms related to DAFs. As you're hearing these, if you're working with us or another community foundation or another organization, you might find that they have their DAFs set up in different ways and offer different options. So the first one there is an endowed DAF, and that basically means most of the fund assets remain invested and a relatively small portion is available to distribute each year. We have a lot of fund holders that have endowed DAFs because they specifically like the long-term aspect of it. They like being able to fund their charitable giving into perpetuity by keeping most of the assets of the fund invested. There are also non-endowed DAFs. So some providers also allow a non-endowed DAF, which basically means you can have those funds available in full at any time. That's kind of the most extreme definition of that. And then there's a lot of flavors in between. And so, I won't go into a lot of detail about all of our fund options, but we also do have options for people that do like the option of investing the larger portion of the assets, but maybe would like to be able to pay out a bit more than would traditionally be allowed under our endowed DAFs. And so, for instance, we have something called the Maximum Giving Fund. That's kind of a nice, middle ground between a pass-through and an endowed DAF. And many other organizations, DAF sponsors, will have other flavors of DAF funds. So as you're talking with your client about it, as you're figuring out, what your client really wants their giving to look like, do they want that perpetual source of funds that they can designate to charities of their choice? Do they want to give out the majority of their assets over a shorter period of time? I think having all that information is very helpful when you finally meet with a community foundation or the DAF sponsor to figure out what fund would be the best fit for that client. Now, semi-related to all things DAFs, this is not my favorite update to give, but there are new regulations issued that came out on November 13th, 2023. And they have, the goal of the regulations is really to clarify the treatment of DAFs and what is a DAF, how are they administered, what are the requirements, how will DAF sponsors be treated. In putting together this clarification, they have drastically broadened the definition of what is a DAF. So there are certain fund types, for instance, advised field of interest funds, that may not currently be thought of by most of us or treated by most of us as donor advised funds, but under these regulations would fall within the definition of donor advised funds. It's created from kind of a foundation DAF sponsor perspective, I think, potential for a lot of additional compliance and a lot of additional uncertainty kind of about how definitions will be applied, how funds will be administered. And it has received strong opposition from a number of DAF sponsors. So I will say we did submit comments on these regulations. Happy to share them if you'd like. We also actually, Bob Sorger, CEO, testified before a panel from the IRS and the Treasury Department regarding some of the challenges that these regulations as drafted pose to community foundations. I think the big thing that we saw when looking at those regulations was they try to treat all DAF sponsors uniformly. And given the difference in types of organizations that are offering DAFs, it becomes a little difficult to kind of apply one bright line rule because some of them have very different business models. So I think that's something that, people really wanted the Treasury and the IRS to think through a little bit more as far as how is this actually going to work and what are the practicalities of this. Now, from an advisor perspective, the bad news I have for all of you is if you are classified as a personal investment advisor under these regulations, you may be prohibited from receiving compensation for services you provide to DAFs. So if you, for instance, are a third-party asset manager for a DAF and you're currently receiving fees, there's a possibility that that will not be able to continue. Essentially, what would happen is any fees paid would be subject to excise tax. It would automatically be an excise benefit. So there are a lot of concerns around this because there are some exceptions baked into the rules also that kind of favor large kind of charitable gift funds, commercial gift funds versus smaller DAF sponsors, and just a lot of complexities about how is the compliance for this going to be handled, how are definitions going to be applied. So I just wanted to get it on everybody's radar and just let you know that that is out there. My understanding is, there hasn't really been any further action on them since they received testimony on May 6th and May 7th about it. One thing that we are hoping we will hear something on soon is a change to the effective date of the regulations. As drafted, they have a retroactive effective date to basically the first day of the tax year in which they are finalized. That's obviously very scary for a lot of, foundations that especially do granting and things like that. There are some people that had expressed apparently during the testimony and some of the meetings that, there's concern about grant making because they want to know what this is going to look like and if the regs will apply and how they will apply. So what I've heard is there's hope that maybe something will be issued at some point soon saying that, any regulations that are issued will only be prospective or there will be a transition period as opposed to applying them retroactively. So we are keeping an eye on it. I know a lot of organizations are keeping an eye on it. A lot of commercial gift funds and investment banks are also keeping an eye on it because there's just very fundamental changes to how DAFs had been previously treated. And I think there's a lot more questions spurred than actually answers maybe contained in the regulations. So stay tuned there, but I did want to let you know kind of what was going on. At this point, I'm going to turn things over to Jen and Jessica for the majority of our discussion, which will be how do we take all of this information and these tools and find something that's the right fit for clients.
So I'll go ahead and kick that off. I guess I would just say regarding the last thing that Alison just said, we're really hoping that this whole thing doesn't come about. I mean, it's, and I think especially the retroactive part of it. So like we're trying to set up plans for clients today and get these donor advised funds set up. And so there's just that uncertainty is not helping any, I think. But let's just hope that it all goes away and they find something else to pick on. So in terms of, what tools make sense when, yeah, I kind of said this earlier. I think a lot of it is you as the advisor, knowing your client, knowing their pain points, knowing the opportunities. And so what we hope to do today was give you a better idea of what all tools are available, and then maybe give you some idea as to how you would even approach a specific client situation. So I think a lot of it starts with the financial planning that you're doing. So what do they really want to accomplish? What's the family dynamic? And so looking at things like direct giving. So what do they have? Do they have too much of something? Too much stock in one position, too much cash that's not doing anything. They don't really want to invest. Do they have life insurance that maybe they don't really have a need for anymore, but maybe that's something that could be used as a charitable strategy there as well. The QCDs we talked about, again, for some clients, especially those with really large IRAs, when you run a financial plan and you look at those RMDs down the road based on just a reasonable interest rate of investment, some of those can be quite large. And so I think sometimes we get the retired client who has more income than they need already from pension, Social Security, Wisconsin retirement. Now they've got, 200,000 of RMD income coming in. Well, that's not money. Now they're paying tax on that income. They don't really need it. So there's ways to maybe kind of prevent that potential from happening down the road by maybe doing some QCDs and using it as a strategy for the client. We talked about, the giving funds, that's like the DAFs and the donor designated funds. The CGA, again, for certain clients may be the right approach. Supporting organization, we're going to talk a little bit about private foundations and family foundations. We're going to kind of come up on that next. But I think, I guess for me, and then I want to turn to Jessica, for me, I think as an advisor, I'm looking at what are the client's goals, and then what are the resources available to meet those goals, and having charity as a goal, and what all is available to fund a charitable goal. How much is it during your lifetime? Is it all at death? Is it some now, some later? Kind of who's in charge of all that, so that, if the client passes away, is the family going to continue doing the giving? So a donor advised fund has like a successor on it who would be continuing to make donations potentially, or have it go out to one charity at the end. And I think the second thing is really looking at how to maximize the tax advantages for your client. So with financial planning software, what I've done is run multiple scenarios. So let's say we do the donor advised fund, we put in X number of dollars. Here's what that does. Let's say we use the QCD strategy every year. Here's what that does. And so you can kind of use those tools available as financial planners to maybe help the client and educate them on all the options and what might be the best approach at the end of the day. And I think, like I said before, I think clients who have potentially a taxable estate in 2026, so that would be anybody with, let's just say, 10 to 12 million today, a married couple, looking at a charitable strategy potentially that might help the family avoid estate tax would really be something timely to be talking about now. If we have 18 months, this is really something I think we all should be planning for today, and at least having those conversations. So Jessica, do you want to add anything to that, or anything else you want to cover on what makes sense when?
Yeah,
Which is not an easy question to answer.
Right. I mean, it depends is like the best answer on that, because you really have to get to, like Jen said, like what's the client's goal, and then what's the best way to do it. So you can have a really good tax plan of saying, hey, here it is, you want to fund this. And the best answer is they have this stock that has a really low basis, and that has the beautiful tax aggregates there. But then for the client, there's a sentimental reason to still hold that stock, and they don't want to go ahead and do that. So you have to know your clients from that. You can give the best tax answer to maximize the charitable gift that they want to go ahead and do, minimize the tax goes with it. But then there's the other stuff that goes ahead and drives that conversation for that. And I think I'll save the horror story from that part of it till we move on before I split for that. But yeah, it's knowing the client and getting their goals of what they want, and then giving them the best option.
Yeah. So I did want to talk a little bit about the private foundation and what this is. So we kind of talked just, about it. I mean, some of you may be familiar with this as something that maybe your client already has, or maybe they've talked about. And so I think private foundations is basically the client setting up their own foundation, usually doing that by having a legal document drafted. And so it's a expensive endeavor, and it's a pretty complex endeavor. And so I think back in I'm going to say the olden days, before donor advised funds were really a thing, clients who really wanted to give significantly to charity may have gone the route of their own foundation. But I think now that donor advised funds are so easy to access, a lot of clients have maybe moved more that way because of the complexity and the cost involved. And so I think for some clients, when does it make sense? I think a lot of it is just knowing, again, what is the ultimate amount of money we're potentially going to be shifting to charity and over what time period. So I guess to me, I think when a client has, let's say, 5 to 10 million or more that's going to charity, it might be a situation where a private foundation or family foundation might make sense for them to set up their own. Not necessarily, but I think you kind of have to have the right amount of money to make it all make sense. Because as Jessica is going to talk about, having a foundation means tax returns and tax filings and kind of things that add to complexity, which therefore kind of adds to expense on the client's part by having more structure. Whereas like the donor advised fund, typically is low cost or no cost to set up, doesn't have any annual tax filings associated with it. And so it's really kind of an easy way to get in. But the foundation is more complicated, but you also have maybe more control because you're really setting it up yourself. So Jessica, do you want to maybe chime in on what's more complex with the foundation versus the DAF?
Yeah, for the private foundations, I mean, like Jennifer said, you have an annual tax requirement to go ahead and do that. So you have a tax return filing. There's a minimum based off the assets that you have to distribute each year to do that piece of it. So there's heavy compliance. And like some people like that part of it, especially for larger families with wealth that want to go ahead and build in kind of that philanthropic and community responsibility to that next generation from that. And so that's where you see them work really well to go ahead and do that part of it there. But the DAFs make it just so easy to go ahead and do that. And it, like Jen said, 5 million or more, that's probably about the right threshold for that because of just the compliance costs related to it. You kind of lose some of that benefit. And the growth of the donor advised funds are just so easy for that. I think the other piece too is picking then what assets to fund into that private foundation. And I think that's where the war story came in, is that had the great thing to go ahead and do that, had this nice, really low basis stock that was the right answer to fund it. But the sentimental reason kicked in, and then they went ahead and used non-publicly traded stock that you don't get the fair value tax deduction. So they did it, but they funded it and they were left with cost basis. So the tax benefit was nothing basically for this situation. Now, ultimately, if that, non-publicly traded stock ends up being the unicorn and it becomes the next, Amazon of the world, okay, then I guess we're all going to be sitting here like, yep, you were wrong from that. But in that present calculation of like what's going to be that tax deduction on the tax return, it was definitely not the right asset to use to fund that private foundation.
Yeah. So I think the last point we want to make on the donor advised funds is that sometimes there's a way for the donor advised fund to work with a private foundation. So the last point on this slide is that potentially a foundation could be paid out to a donor advised fund at some point when that foundation would terminate for whatever reason. So there's a way to kind of bring those together. And I think for some clients that may have set up the foundation, they may want to switch to a donor advised fund sooner than later for other reasons, just to kind of, again, eliminate the complexity and the additional expense and filing and all that kind of stuff. Alison, do you want to go to the next slide? And we can just kind of look at, kind of the spectrum of, the low cost to the high cost. Yeah, so I think this is a good chart to kind of summarize. And I know we're kind of getting to the end of our time here. We want to get to some questions, but I think this is kind of nice because it sort of covers everything we already talked about, all the different strategies, and then the low cost, low administrative, high cost, high administrative. And so I think the things like the private foundations, even the charitable trusts, the charitable remainder trust typically is a custom document that a client would have an attorney draft for them. So that adds to expense. The charitable lead trust, kind of similar. The gift annuities are lower cost and lower administrative expense because perhaps the community foundation can help set that up for the client. So that's kind of a different approach. But I think here's again where you're going to want to know your client. Will they appreciate the high cost, high administrative option because their situation is that complicated? Or are we able to kind of accomplish the same goals by giving a charity in a meaningful way, in an organized way that has huge tax advantages, but keep the low cost, low administrative? That's always my preference. Let's keep it simple and do what still accomplishes the goal. But again, based on the client situation, you may not have those options, or they may not be as appealing as doing something where they're going to get a bigger deduction by doing a foundation of their own. So my war story, just really quick, is I had a client who set up a family foundation, and this was pre-2016. So again, the QCD wasn't an annual thing you knew for sure you could do. So they set up the foundation, which was expensive to draft, kind of a big the big document. But then when we really came to funding it, the clients mostly had all their assets in IRA accounts. So the IRA account can't go into the family foundation. And so what we really found as we really got into it was that doing the qualified charitable distributions from the IRAs had much more value to the client than trying to use a family foundation that really didn't work together. And so I think that was kind of had been done at a time when we did the best we could at the time. And now we're really changing the strategy. And I've got a foundation with basically no money in it, and they're not really utilizing it for gifting, and they can't really put anything in it either based on their assets. And so, I think knowing, and I think being sort of flexible down the road to figure out, hey, we did this when we thought this was the best idea. We've got new ideas now, or new strategies to talk about. And some of those things can be unwound. So potentially this foundation I'm talking about could go into a donor advised fund. And then they would still be able to use the QCDs to do other charitable giving directly to the charity. So there's some different options there. Jessica, anything else you want to add on that before we wrap up here?
Yeah, I mean, it seems like with the private foundations, I think part of it ends up being a prestige factor to say, hey, I have a family, have my own foundation from that. And you can easily get around that because you can name your DAFT the family foundation from that. You can call your DAFT whatever. I mean, the high administration cost that comes with a private foundation, the worst ones I see are the ones that kind of just funded each year. I put in $100,000 and then I turn around and I give that $100,000. And I'm like, why would you go ahead and continue to go ahead and have the, cost of paying for the tax return, drafting all those documents, when you could have just set up DAFT. Now, some of these are just old legacy ones that DAFTs didn't exist from that, but it's, again, why are you continuing to kind of go ahead and do this? But you got to know your clients, you got to know that situation, and maybe that administration cost is worth it when the fact patterns matter the most.
Yeah. So I think if you want to go to the last slide or next slide, Allison. So final thoughts, and then I think we may have a couple of minutes for questions here. So again, as you've gathered from the talk today, this is not a one size fits all. It's not always an easy answer. Your client is going to have a very specific situation, very specific needs, desires, their taxes, all that kind of needs to be mixed in. And then I think the giving and the planning and the tax planning especially really should be something you do throughout the year with your clients. It's not at the end of the year, let's figure out what to do. A lot of this can be done, throughout the year and in a more meaningful way. And so, we typically like to work with, people like Jessica who want to do tax planning all year long with clients, not just at the end of the year, so that we're really proactively looking at what's in their best interest. And then if you want to talk, Jessica, about the last point with what we're coming, the pre-post world we're coming back to.
Yeah, I mean, the tax laws are what we know are today, right? Could they change them? I mean, not likely from that part, especially not likely this year from that. It all depends on election changes of where the wind's going to blow with that. But we don't want to wait to then say, okay, here it is. I mean, if you go to history of tax law changes, some of them, it's December 22nd. Yep, you got a lot of opportunity in the last 7 days of the year to do something to do that. So it's starting that conversation because if these are going to be bigger gifts for planning, there is the emotional aspect that kind of comes from there. And you want to get that idea so that their goal of how much they want to leave for charity, what do they want to leave? Do they want to do it in their life? Do they want to see the gifts impacting their community as they go? Like, those aren't decisions that are made with a snap of a fingers. People take time and thought to get into it. So it's having that conversation today so that you're ready to go to get everyone's best interest made, the goals they have for their charitable plan, and the best tax answer for them while they're doing it.
Awesome. Well, thank you so much, Jennifer and Jessica. I'm looking at the Q&A. I don't see any open questions right now. If somebody does have a question, please drop it in. We'll address it. I did want to hit on one final point. regarding QCDs, and this is a question that we get a lot. QCDs cannot be used to fund a donor advised fund in most cases. So every year around November, we start getting a variety of phone calls asking that question for both advisors and potential donors and things like that. So I just want to make clear, you know, as you are doing planning, if it is QCD planning, there are other fund types that, you know, you can absolutely give to with QCDs. So donor designated funds, field of interest funds, you know, general funds. But, you know, donor advised funds are kind of the no-no as far as QCDs go. So when you're having the QCD conversation with your client and they say, that's great, let's set up a donor advised fund, remind them they cannot do that with the QCDs. So with that said, I want to give a huge thank you to Jennifer and Jessica for sharing their expertise with us and their knowledge and their work with clients. I've included their contact information. Happy to share these slides. Just email me and I will send them out to you. I did want to give you a couple final reminders. You will be getting a webinar survey. Please, please, please fill that out. Good, bad, otherwise, let me know if there's other material you want to learn about, other resources we can provide. That would be great. And please mark your calendar for our event on September 10th at Monona Terrace. Keep an eye in the meantime on our advisor blog and our LinkedIn. We'll share some other updates, and then we will also share info on our upcoming October and August webinars. So thank you so much for attending today. Thank you again, Jennifer and Jessica. We look forward to having many more of these important conversations. Take care and have a great week.